Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, March 4th, and today's market mood is basically, I'm calm, said nobody, while oil and rate expectations do parkour.
I opened my investing app and it looked like a soap opera recap. War headlines, oil spikes, stocks bounce, dollar slides, gold, faceplants. My safe haven is apparently a trapdoor.
We'll make it usable. 3 stories. The Fed signaling an extended rate pause, oil's whiplash around Iran and the Strait of Hormuz, and why stocks can rally even when the headlines feel like a stress test.
And at the end, give me a normal person action plan. Like, what do I do besides refreshing charts and whispering diversification into the void?
Story 1. A top Fed official, Cleveland Fed President Beth Hammack, warned inflation risks aren't gone and argued for holding interest rates steady for quite some time. Translation: don't assume quick cuts just because you're tired of high rates.
So the Fed is basically saying, we're not mad, we're just disappointed in inflation, and they're grounding us from cheap mortgages until further notice?
The simple version: the Fed's job is to balance prices and jobs. If inflation might reaccelerate, especially with energy shocks, they'd rather pause longer than cut and then have to hike again. It's like trying to diet while someone keeps delivering pizza to your house.
And the pizza is gasoline. Great. What's the watch this next for listeners? Like 1 or 2 numbers that actually matter.
2 things: inflation expectations and labor cooling. If energy pushes headline inflation up, the Fed gets nervous, even if core is calmer. And if job growth slows meaningfully, that's the counterweight that could justify cuts later.
Actionable takeaway. If you've got credit card debt, this is not the moment to wait for rates to fall, right? Because the Fed just hit snooze on cuts.
Exactly. Prioritize high-interest debt. For savers, keep an eye on cash yields and short-term bonds. They benefit when rates stay elevated. For homeowners, refinancing may stay tough. Focus on shopping insurance, property tax appeals, and principal payments if it fits your budget.
Okay, story 2. Oil. I saw oil erased gains, and then oil steadied, and then my brain erased itself. What happened in human terms?
Oil jumped on fear, then gave it back on diplomacy headlines. One report said Iran indirectly reached out to the U.S. to try to end the war, which cooled the immediate supply disruption panic. But the Strait of Hormuz remains the big choke point risk that keeps a premium in prices.
So oil is trading the vibe. If the vibe is talks, prices chill. If the vibe is blockade, prices panic buy like it's toilet paper season.
That's basically it. Finance behind it, oil isn't priced just on today's barrels, but on the probability of future disruption. The strait is like a single bridge on your commute. If there's even a chance it closes, everyone bids up the detour cost immediately.
And normal people feel it as higher gas, pricier flights, and your online order arriving in the year 2049. Also, my grocery store suddenly acting like olive oil is a luxury asset.
Yes, energy filters into shipping, plastics, fertilizer, and eventually food and services. That's why oil shocks can revive stagflation fears, slower growth plus higher prices. And that loops back to story 1, making the Fed less eager to cut.
Story 3. Stocks gained on hopes for a swift end to the Iran war, and the dollar slid after a couple haven days.
When fear spikes, money often runs to perceived safety, like the dollar and short-term treasuries. When fear eases, that safety trade unwinds. Stocks bounce, the dollar can soften, and oil can stabilize. It's risk on versus risk off, switching faster than your streaming app asks, are you still watching?
But gold falling is the plot twist. The world is on fire and gold is like, actually, I'm busy losing 5%. What gives?
Gold can drop if the market reprices interest rates and the dollar. One report tied the sell-off to fewer expected Fed cuts, about 46 basis points priced, plus a stronger dollar and profit-taking. Gold doesn't pay interest, so when cash yields look attractive, gold can lose some shine.
So gold is like that friend who only shows up when the party is bad. But if the bouncer, interest rates, gets stricter, gold leaves early.
Let's land this with a 30-day playbook. 1. Run a gas and groceries stress test. Assume energy-linked costs rise and tighten discretionary spending now, not after the statement shock. 2. If you carry variable rate debt, accelerate payoff or look at consolidation options carefully.
Stop trying to day trade geopolitics from your couch. Unless your couch has a risk desk and a compliance department, in which case, invite me over.
4. For long-term investors, keep contributions steady and rebalance if your allocation drifted. Energy spikes can distort sector weights. 5. Keep cash for near-term needs in high-yield vehicles, but don't let waiting for clarity become missing your plan.
If this helped, subscribe to BD Daily Finance News Podcast and send this to the friend who texts you, "Should I buy oil?" like you're OPEC with feelings.
Drop a comment with the one number you're watching this week, oil, inflation, or yields, and we'll cover it. Thanks for listening on 2026, March 4th. See you next episode.